Good afternoon, traders, and welcome to the FOMC Live. So any second now, the FOMC minutes are going to hit the tape and the market is going to start to burst. It's going to make a huge move one way or to other. Here we go. And we have a way of handling these FOMC meetings. We have sort of a system that we like to use to approach them. First and foremost, never go with the first move that the market makes. So if the first move is a break higher or a break lower right away, almost always the market will retrace that move shortly after. Okay. So we don't want to go with the first break. Once the market kind of comes back into range, then we can look for it to pick a direction if it's going to. Okay. There we go. Drawing tool up and running. So here we can see that this first move is a move to the upside. So you don't want to be going long, even if it keeps going and going, because at some point it's going to come back in. It's going to come back into the range. Okay. It'll do whatever it's going to do for the next 10 minutes or so. It's going to be volatile. It'll go up, it'll come down, and maybe keep going and maybe won't, whatever. And then it tends to kind of slow down about 10 minutes from now. We'll call that, 210, 215-ish. It'll slow down and then it'll kind of go nowhere until 2:30, which is when Powell comes out and speaks. We'll watch that together and we'll see what the market does. Generally speaking, if the market is going to do something really gnarly and crazy because of FOMC, say make a huge move up or a huge move down, it will generally do so once Powell starts speaking. And it'll kind of just pick a direction and start pumping. So let's say there was your initial impulse, there was your retracement back into the range. Let's say Powell comes out and the market is kind of pressing lower, and he keeps talking and it just keeps pressing lower. Those are the type of days where you get the big move to the downside, because it'll keep going as long as he keeps talking. So we never know. I would say out of the last 10 FOMC meetings, at least 5 of them have been nothing burgers, where the market basically just ended up right where it started. So we're not going to get overly excited here, but it should, if nothing else, be interesting. And we should get some nice volatility. We got Will in the house. Thank you for the like. Appreciate you. Malcolm is here. He says Captain Condor has been holding firm with his 68.60, 68.65, and 68.15, 68.10. Hasn't let off too much. Yeah, I mean, obviously he's waiting for whatever's going to happen in the FOMC. That's got to be the play. But looking at your Condor, it must mean he thinks it's going to close inside that strike price. Yeah, so he thinks the market is going to drop. Roughly 50 points or more from here. We shall see. They have been letting off a little bit down here. It's FOMC day. Buckle up and saddle in. Let's get ready to rumble. Papa Powell's here. Will in the house, good morning to you. Ahoy. Candle Swinger says, don't let yourself walk the plank. Yes, please hit that like button. The more likes we get, the more new people we see. Percy in the house, hello to you. Mark is here. Paul. If you guys have any questions for the pirate, let me know. I would actually say this is kind of already slowed down quite a bit. I would have expected to keep that sort of tempo from those first couple minutes going for at least 5 minutes. If the market starts to break above 64 again, it'll be easier for it to keep going the next time. But for now, this is very uncertain in here. And tempo already slowing down. TY in the house. What up, y'all? Are y'all ready for this? Hey, welcome to Dan. Thank you for the sub. Okay. So, like I said, above 64 could start to get a little follow through, a little bit of acceleration to the upside here. But, you know, don't fall in love with a long trade if you're going to take one, because all these icebergs below are telling us the market will probably come back again, come back down towards that G period high. So we're going to get a little spike, a little bounce. See what happens at yesterday's high. Okay, broke yesterday's high. That's bullish. Now the question is, can they stay there? Ooh, they canceled the first iceberg. Yeah, look, they're doing it again. Another iceberg. They're trying to get everybody along at yesterday's high. They're trying to convince you. So they can sweep it right back down. Dan in the house, welcome. Happy to see you. Papi says, how much do you all pay for software on average a month? Seems like bookmap traders have 3+ systems. Yeah, if you paid for everything that I pay for, you paid for Window Trader, you paid for the data just for Window Trader that I pay for, the bookmap, and the Spot Gamma as well, you'd be looking at about $900 a month overhead. But it costs money to make money. You got to run a business. You need the tools. That's just how it goes. Okay, so it's now 2:10. As I said, between 2:10 and 2:15, things tend to kind of slow down a little bit. The tempo, the rate of change kind of tends to chill out a little bit. My guess here is that they want to make one more little poke up. I think they want to try to convince some more people to go long here, but I suspect before Powell starts to speak in 20 minutes or so, it's going to drift back down towards that G period high, towards 68.60. And that's just because of these icebergs that are here. They're a magnet telling market, hey, if you come back down, there's liquidity waiting. So it tries to get everyone long up here, one little push, and then back down. And we are monitoring the changes in the tempo. Does it slow down or not? All right, guys. Well, we got 15 minutes of nothing burger likely ahead of us here. As I said, I think we're going to slowly drift back down into the range. Any questions? Anything you want to know in the meantime? Or are we all just going to kind of relax and wait for Powell to come out at 2:30? So the survey is out. We are currently at 68.67. 68.67. So do you think by the close today, price is going to be higher, lower, or basically go nowhere? Where do you think the market is going to go once Papa Powell is done speaking? Malcolm says we're going to relax. Well, apparently not, Malcolm. We're going to chat. Grizzly Bull says, can we take a look at corn? I cannot pull it up on Market Profile, but I can look at it on a regular candlestick chart. Corn futures. Okay, very interesting. Balance inside of balance, inside of balance, inside of balance. The price of corn does not change that quickly, does it? Okay, so what's jumping out of me? Well, there's two different balance areas that I'm looking at right now that are kind of catching my attention. 2P2, where is channel? There it is. The first is there's sort of a channel happening right here. Just a quick draw, something like that. So that's a form of balance, right? The market is working its way from one end of the channel back to the other, again and again. And then there's also the horizontal balance that's happening, which is that right there. And wouldn't you know, both of those channels, you are knocking on the end of the world door. You are. Yeah. So both of those balance areas, so to speak, are really being tested right now by price. I would say, certainly if not today, by tomorrow. And if they start to fail and the market starts to poke through, whether you're looking at this balance area right here, which would imply a move like that, over the week or, over the next few days, or this balance here, which would look for a move like that over the next few weeks. Either way, that would start to get bearish. So I would say corn wants to reverse and start heading back up towards 449 tomorrow. And it sure looks like it's going to, because, man, that is in balance. He says, I meant Bitcoin. Oh, yeah, Bitcoin. Well, now, in case you want to trade actual corn, you can. Okay? That's funny. All right, let's take a look at Bitcoin. Same thing in reverse. Oh, my God, they're doing the same exact thing in reverse. Bitcoin's got a channel, and they're testing that channel. And it's got horizontal. And they're testing the breakout of that as well. You can actually call it more like that right there. So yeah, Bitcoin, exact same thing as actual corn in reverse. Bitcoin trying to poke through resistance here. And I'd say if it can get above yesterday's high today or tomorrow, you're looking for the next move up as a breakout of balance. And again, same story. You got horizontal balance. That gets you your first little wave. And then breaking out of this balance gets you that next wave. Back up to 110. If you can break out. Break out! Because if not, you keep balancing. First you rotate down to this. Then you rotate all the way down to there. And that would be bad. Dan says, what is your strategy, Charles? Are you trying to carve out something at the beginning or waiting for a move closer to the end? It's a great question. First and foremost, before I answer that question, let's finish up the survey in the chat. Where do you think the market is going to go? Last chance to vote. Vote now or die without ever having shared your opinion with anyone. Do you think the market is going higher, lower, or nowhere? From 68.67 by the close. Let us know right now. Speak now, forever hold your peace. Only 34 of you voted, but the results are very unhelpful. 41% saying higher, 41% saying lower, and 18% saying sideways. This is why more of you need to vote. Okay? Because right now the vote is telling us people just don't know where we're going to go. So the question was, how am I going to trade this? Am I going to try to grab something in the beginning, or am I going to try to wait and grab something later on? The answer is there's one way and one way only to trade the FOMC, and that is what I call the butt cheeks trade. It's very simple. Powell's going to start speaking. The market's going to do whatever it's going to do. Maybe it starts going in one direction. Maybe it just kind of keeps, grinding around in a range. Okay. I'm just going to watch it. If it seems to start to pick a direction, so if, he's been talking for 5 minutes and now all of a sudden we're gaining momentum and we're doing a lot of just up and down, but we're slowly kind of working our way higher and higher and higher as we're doing it. Somewhere in there, I'm going to squeeze my butt cheeks real tight and I'm just going to get long. I'm just going to smash the market buy button. I don't have a stop. I don't have a take profit target. I'm literally just going to get in because it'll probably be moving pretty fast and it'll be hard to nail, an exact support level to buy a dip. So just get in as soon as I feel like I see that momentum up. The second I'm in the profit, say I'm 1 point or more in profits, I'm going to go ahead and move my stop a tick above my entry. And then I'm going to sort of just trail it as price continues to pump higher. Now, I'm probably going to get taken out at some point, right? Because I'm trailing my stop. At some point, it's going to come down and tag that stop. So I'm not going to catch the whole move. But the way that this trade can be very, very profitable is if this is one of those days, one of those FOMCs where this thing is going to make a 80-point, 100-point move from here, which it absolutely can. I'm not saying it will, but it can. If you get into a trade 20 points into it, there's still another 30, 40, 50 points of profit to be made. And all you got to do is get in, take your risk off by getting your stop above your entry, and you can catch a pretty decent piece of it, even if eventually you get stopped out, because you're trailing your stop. So that's the way I like to trade it. Butt cheeks to get in, trailing stop to get out. And I only do that if there's a strong directional bias. If it's the choppy sideways thing, I don't touch that. Not even for a quick scalp because it's too random. Okay, so as expected, we are drifting back down towards that G period high before the big man comes out. Tom says, pirates. Uh-huh. You've come to the right place. Crypto Writer, you're welcome. Enjoy. Crypto Writer says, now we found the new correlation. When Bitcoin goes up, it's no good for real corn. We have it. We've solved the riddle. Tom says, does volume profile help with FOMC? No, not really. I mean, support and resistance levels do still play out. If you look at the top of the screen where it says resistance, look at where the market reversed just now during FOMC. Exactly to a tick where I marked a line and wrote resistance. So when did I mark that line and write that? Yesterday. But Charles, how could you yesterday know that the market was going to flip and reverse exactly at that level today during FOMC? Well, of course I didn't. I was just using volume profile. I was looking at areas, the market had momentum. It was working its way higher. I was asking myself, where is that going to run out? And I was looking at volume profile. I was looking at these previous days where resistance became support. And I was thinking, that's a good spot. That'll be my resistance level. And we didn't get there yesterday, but we did today during FOMC. Amazing, crazy reaction. Oh my God, market moving 100 miles an hour, and look at where it reversed. Exactly to a tick. So does volume profile matter? Kind of in that way, in knowing where important support and resistance areas are. But in the end, nothing matters during FOMC. It's a chain reaction. You know what I mean? One thing starts to cause that firecracker effect, and that affects the next thing, and that affects the next thing, and then you get these big, kind of crazy moves, just because everyone is reacting to what everyone else is reacting to. Which, of course, is the color of Powell's tie. You only got 3 minutes, only got 3 minutes. The conspiracy theorist in me is feeling like they're pushing it down right now so that once Powell starts speaking, they can turn around and bring it back up. I'm noticing several things, okay? There's a lot of liquidity way above price here. 68.90, 68.80. There's liquidity sitting up there. And you can see as they were adding that liquidity, it was kind of scaring price away, okay? But if they pull this all of a sudden, randomly in the middle of Powell speaking, it'll become like a magnet for market to start to turn around and come back up, because it's a negative magnet right now pushing market away. It's simply disappearing kind of relieves that pressure and the market can turn around. And then we also still have that iceberg. Whoops. That iceberg right there at 68.75. And so again, that's liquidity. The market knows it's sitting there. It knows if it comes back up to that high again, it'll get at least some orders filled. So even if it wants to go lower, shouldn't it come up and just fill those first and then go? So that makes me think they're pushing it in so that when Powell comes out, they can start the train up. We'll have to wait and see. We only got 1 minute, 1 minute. 1 minute to Papa Powell. Yeah. Here comes Papa. All right. Well, I'll quiet down my mic now so we can listen to him speak. And if there's anything that I think is worth talking about on the chart, I will jump on and explain.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September.
Okay, so I'm going to make kind of a weird call here. Same exact thing I said when we were down near the lows. When we were pushing down here, I said that iceberg meant the market was going to come back up for it. Well, guess what they're doing now? They're coming back up for it, but they're leaving another iceberg down at the low again. So my call for today is now becoming nothing burger day. I think we're going to get a little move higher, and then it's going to retrace back in. That's the vibe I'm getting here. Because they wouldn't have left behind that iceberg if they wanted this thing to break and just trend higher all afternoon. So I think we're going nowhere.
Labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment.
Just to answer a question that jumped up in the chat, somebody said, does that iceberg at the low, does it always, does the market always come back to it the same day, or does it happen on a subsequent day? This could disappear at any moment. That's what, an iceberg, they can change it at any moment. So it could just disappear right now, and then they're not coming back for it. There's no guarantee they come back for an iceberg. It's just when it feels like the market is being artificially pushed around, which it has all day today, generally those icebergs don't get ignored. So it doesn't mean it can't run away. It just means it's going to come back sooner or later. So at this moment, I would describe this as a butt cheeks long trade, where the market is cranking higher. And so if you want to get in a trade, you want to go with the direction. But as soon as you're in the profits, you want to move your stop to a profitable place. Because I do think at some point, they're going to come back down to 68.50. As soon as they're done, getting everyone long first. And I don't think they're done with the high either.
Allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement,
Okay, so now that Powell is answering questions, if the market, so the direction the market picked was obviously up, if the market is going to keep cranking in this direction, it should start to just slowly melt its way higher from here. If it comes back into the range again, then it's just going to be choppy sideways for the rest of the time that he's speaking. So they've picked up as their direction. Can they pump it? Let's find out.
And as we noted in our statement today, we are well positioned to determine the extent
And
and
the answer
timing
is
of
no.
additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September.
Okay, well, that was quick. So there we go. We're back inside the range. So this tells me this isn't probably going to be one of those FOMCs where the market makes a big, 100-point move and completely changes. I have a feeling we're probably going to close somewhere inside yesterday's range. So we may get some up and down volatility here, but then it's probably just going to end up closing somewhere inside yesterday's range.
Improving productivity out there. What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level.
Okay, so we're coming in to tag that iceberg.
I mentioned that the SEP.
Coming in to tag that iceberg we talked about at 68.50, and then we'll see what happens. Does it just absorb and then reverse and come back up, or do we get more selling below 50?
And 25, so it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and you know, it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and you know, we come together and we reach you know, a place where we can make a decision. We made a decision today. We had, you know, 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, you know, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and, you know, the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in you know, inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to, you know, the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do 2 things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, The committee did 2 discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both showed declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate.
So I know it doesn't feel like I know what I'm talking about here, but I still think this thing's coming back into range for the close. Okay? I still think they're just poking up right now to take out as many stops as they can, to convince as many people to long as they can. So I think this thing is going to find some resistance, probably around 95, and then come back in. If it starts to stay up above 68.86 for a substantial amount of time, let's say for another 20 minutes, it were to stay up here, then I could be bullish for another move to the upside. But I really think this thing is going to drift right back down. Looking for that resistance.
Beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, it takes, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Like,
No mulligans for it. Michael from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation? So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, you know, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and you know, we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. You know, we didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high.
Papa Powell says, "Fuck your groceries. I don't care." Okay, so the air is getting thin up here. When we talk about volume profile, what we can see is, you know, as the market is pushing up, the volume is getting very, very thin up here. Okay, so it's a lot of just large orders of stops getting taken out that's kind of keeping this thing chugging higher. I will say they have spent enough time to officially have acceptance above the high from Monday. And that is bullish that they could close up here. But the next thing that they will need is they will need to bring in some volume up here. They'll need to, you know, turn a candle pink somewhere up in the upper end of this range if they want to close up here. Okay. If Powell stops speaking and this is still all white candles, then we'll retrace. But if we can turn some pink, then we will probably close in the upper end of the range. The question I'm asking myself right now is, you know, over the last few weeks, we've seen the market is pinned, which basically just means it's trying to get away from 68.40, and it has not been able to. So if the market is still pinned as of now, then by the end of the day, we will retrace a lot of this. Like I said, at least back below 73. Okay. But if we're able to break away from the pin today, that could lead to multiple days of upside continuation in the days ahead. And really, the way I see it is, can we close above 86 or not? If we don't, we're coming back in. If we do, we're going to stay out here and potentially break higher tomorrow. So we are looking to bring in some volume up here at the upper end of the range. Turn some candles pink. Next major resistance to the upside is 69.13.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, you know, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you. Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low low-rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's, I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right. That is it for the Papa. That's why they call him Big Papa, because he says a few things and the market makes moves. That's why they call him Big Papa. Okay, so we did bring in that volume that we talked about at the high. We said if they wanted to close up here without retracing, they got to turn some candles pink. They did do that. That is bullish to see. However, I'm still getting this thing is going to drift back into the range vibes. So I was basically waiting for him to stop talking and kind of, the anticipation of anything he could say could cause the market to spike. That's gone now. So now the market kind of has a chance to cool off and absorb this move. So there's one of two ways that's going to happen. We're either going to stay up here or we're going to retrace back into the range. So I would say just keep an eye on this high right here around 68.86. As long as we're above it, you should be bullish. If we cross down through 86, you're definitely going to backfill the single prints to 76 and probably even all as far down as like 61. Okay. But if they can stay above 86, then we can close up here, maybe even with another spike, close to the end of the day. But like I said, the reason I think we're going to come back into the range is because of the fact that the volume is so thin up here. So now that the chaos is over, now that these, large orders are going to slow down, it should drift back in. Another thing that has caught my attention over the last few minutes is this large node of liquidity here around 68.90. As soon as that popped up, it became support for the market. Okay. So again, as long as it stays there, probably the market stays above 68.90. But if it disappears, market comes crashing through. And it would disappear as the price got to it. Right at that moment is when it would disappear. So I won't know for another 30 minutes or so how I feel about breaking away from the pin, but I am hoping that we are breaking away from the pin here. So if we do close above 86, if we do close above Monday's high, then I will see that as bullish going into tomorrow, assuming this market wants to try to work its way back up to the all-time highs. But like I said, let's give it the next 30 minutes, because if it comes back in, we're still pinned. Dope Angel says, what does Hero Line say? Will it go down or not? Hero Line is saying up. So as that FOMC was happening, essentially the gamma was just drifting higher. The gamma was drifting and drifting higher. And in the beginning, there was a lot of sort of chop and grind in the Hero Line, but eventually the Hero Line caught that change, that people had stopped buying puts and selling calls and started, selling puts and buying calls, and then it switched, and it's been pointing up ever since. So it is quite a move to get from negative 3 billion to 0, and it did that. We can just rewind a little bit here. Rewind back to 2 p.m. Boom. So if you look at where all the gamma is, it's right around price. It's right around 68.50. And then just watch. Gamma drifts. See that? Drifts up. Hero Line reverses. And then boink, 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 boink. So with that, I will say goodbye. I wish you guys the very best. Thank you for watching. If you are new to the channel and you are interested in learning more, head to piratrators.io and you can check us out there. If not, well then, so what, man? You should at least hit the subscribe button. You should at least do that so you can come hang out next time we're live. All right.